Alright guys, glad to have you on board again today. We're going to have the recording of SERIE regarding crypto adoption. Remember, we've been covering the A16Z's reports, that the state of crypto index last year, and well, of course these things have been updated as the time passed, and we had additional data points, and I wanted to cover that one out again because, well, I think there are lots of things and lots of valuable information to be derived out of this. The number one takeaway on today's thing is that, well, I'm pretty damn worried about the same old speculative behavior, like the same old people playing 2021 over again. Like, we'll see that the longer type analysis that we do here can hardly be coming out of fake data sets. Remember, anything can be faked out for a couple of years. We've seen bubbles and bursts, pumps and dump schemes and whatever. They have existed in the past, will exist in the future, and there clearly are some that be in play now. But the truth is, well, you can hardly sustainably fake those data sets over time, which means the longer the time passes, and if you have a clear evidence of a trend, that means there might be some noise coming along with it, some pumps and dumps here and there, but we can hardly imagine crypto now to just be a big scam. It clearly isn't. There are lots of scams in there. Let's just not go there. But that's really what we want to cover with those longer term data sets that prove that there is value below the surface, and we clearly want to focus on that. Remember, there are two ways you can make money in the markets. You can either play the timing game, which means you're going to have to be better than the others. You're going to have a hedge in the market to be more successful than the average. We know that most people lose money in the market, so long as you are somewhat experienced and have a strategy, you're going to be better than average. But the truth is also very complicated to find a market fit strategy and stuff like that. Many people just struggle and trade what they want or what they think is the future. What we're going to be proving today one more time is that this is an absolutely horrific strategy. Don't ever do this, okay? So falling for narratives is probably the best way to forget about doing the best thing to succeed in trading, looking at the jam charts. Anyway, so today we're going to look at charts because that's really, like I said, not a magical tool to forecast the future, but that's always much better than following someone else's narrative, okay? So that's really the way to go. Remember, TLDR is longer term charts like that who pull out data from multiple years in a sequence. They can clearly be faked, okay? You can short-term fake something, but you can't on these longer time scales. Okay, so there's clearly evidence of a trend in here. As you can see, some kind of flat data sets, then palm, very quickly short-lived, and then, of course, new ranging and so on. Kind of these phases of long, flat standing, then increase, consolidation, flat stance, increase, consolidation, and so on. So these are the signs of compounded growth rates. That means generally, you will see a rate of change which is accelerating, which is really the way to go. It means you're speeding up the rate of change. That's really like the second derivatives going higher. So that's generally, markets are trading derivatives. Remember, markets are trading rate of change. And if the rate of change itself is accelerating, we call it the second derivative of momentum, which is clearly what the market likes the most to create a parabolic type stuff. So that's really the way to go. When we have those growth phases, that's really when the market goes wild. And what we can see is that if it was a baseless claim, we would be going back to the same prices, but like we started off, and we clearly do not do that. So there is a compounded effect. That's the sign of general type of adoption system, which means despite those acceleration phase, which we can go crazy, there is still more adoption, which means there is an underlying factor that grows it all up, which means those who might come and some may leave, but there's still an inherent base that sustains itself over time and accumulate as the cycle go by. So that's really how it goes. Remember, we've talked about that a lot in the past, and we're going to talk about it as well today. So let's get it started with this. The state of crypto index is a kind of a global agglomerate of information. And remember, once again, I don't really like too much looking at indices. They give us kind of the broad picture, but looking at what's inside of it is really where the valuable information is hidden. So if we look at this thing, remember TLDR, we have these kind of long-term compounding effects, signs of rate of change cycles, and nothing more than that. But still, everyone would argue that, yeah, we're now in some kind of a steady phase, waiting now for the next pump. Okay, surely, and history has told us that these pumps can somehow occur with 4-year cycles. Well, what does that tell us about the future? Absolutely nothing. Anytime you can predict the future, you can be very well sure that it's not going to play out this way. So God damn it, just make it easy on you guys. The halving is nothing more than a fancy name. It has been impactful in the past because there was nothing else to do but stock to flow ratios kind of modeling. But right now we've clearly seen by all signs of metrics that these simply don't play out anymore. So just forget about the halving. Nothing's telling you that the market is going to go up after it for whatever reason that some people might be calling in for in some social medias. They generally show for their mere incompetence, and to say the least. So that's really the way to go, okay? Remember, for professionals looking at statistics, the halving is probably going to be the hardest non-event ever seen, just because, well, we've seen that the previous elements that were backing those claims, stock-to-flow models and stuff like that, we've diverged from this model for so much of a wide margin to say that we're not following this anymore. Might follow some new stuff, like correlation to the stock market, which is still unstable, correlation eventually to precious metals, and some other things like that, which are still trying to find new grounds to replace what was once before the stock to flow model for your cycle, which clearly to me will have little to no impact this time around. So one thing is for sure, we're in this cyclical behavior, but forget about the full year cycle. Nothing tells you that it's going to have to happen post halving or whatever. It may happen in the coming years, and just call it that way. That's the reason why we pile up this indicator in here, as to say, well, we're now in kind of the steady phase, and we're going to have to wait until the next growth phase shows up. And until it does, well, it's nothing but speculation. And frankly speaking, we've seen that back then there was kind of fake attempts, which just ended up going back there down in the bottom of the range. So we could very well range there for another couple of years, and I would nearly be surprised. So what we're having in here is nothing but, I think, short-term speculation. Moreover, we're going to dive into these things. So if we look at adoption indicator, we would see that despite this, which seems more like an odd system from innovation indicator, would see that this is clearly demand driven. Okay, so there is no increase in supply. It's clearly demand driven. What we've seen in the past as well is that demand generally precedes the supply. That's really what creates this kind of shift into the supply to demand ratio. That's create the shifts in prices, which means we anticipate the demand and then the supply gets to overwhelm the market, and that's what creates afterwards this kind of bear market mechanics. But what we see here is that, yeah, looking at what we have here, we have serious uptick in terms of demand indicators. Well, now we need to dive into the numbers to figure it out. So as we see, the supply is drained, which is a sign of the effect for a bear market, which means same old story in here. As the cycle goes in, we've got growth and then kind of steady growth, steady consolidation. So now this time around, once again, we see that this is not a destructive type of element, which means we still conserve some time of baseline, which we accumulate upon. Same old story. That could be consistent with the sign that this model has passed the chasm phase, because that's the first time in history that we've seen some deterioration, meaning that the number of developers have kind of exited a bit. So we've seen some kind of this consolidation. I think we're really in the chasm phase, which means the next one is where the acceleration will be the fastest. Remember what we're looking at in here, this kind of bell curve, is really the second derivative. That's really the way to go. That means the rate of change will grow until it picks up at 50% adoption rate, and then it declines, okay? And remember, markets are very sensitive to this second derivative type stuff. So that means we're currently there, and this is where we're going to terminate the next cycle with a much higher second derivative, which means the rate of adoption will be the highest ever. We have now, at this stage, onboarded somewhat like 16% of the total addressable market share. The next one is going to bring it up 34, which means double what we already have. Meaning the people today in crypto barely represent a third of the whole thing that we'll get by the end. Okay, so twice that amount is going to be added in the next cycle with a rate of change which is far higher than it was before. But the big takeaway from this is that once again, it's not the same type of cohort. The visionaries and pragmatists have two very significantly different ways to look at the markets. And that's the reason why I wouldn't call for 2021 over again. But that seems like it's really what's at play. Though we'll see this. Interested developers, same thing story in here. We see that there is a slight consolidation, kind of leading us to believe that we really have a pivot, a sensible pivot in the market. This is really like a make or break event. If this time around we sustain and grow again, this is probably going to be the last doubt phase, which means the next cycle is going to be true, legitimate genuine adoption. And that's really, really what I'm very excited about, which means why the heck would you be front running this, like trying to time it out with margin, leverage trades, like I know what the future, and I'm gonna jump in now, like 2021 over again, like I know what the market is going to be made out of. Let's just buy the narratives. People will obviously going to have to buy them later. Well, that's clearly not true. We'll see that. Contract deployer, this is where it comes. So basically in here we've seen that odd data stuff that we've seen earlier in the data series, clearly showing that this is odd type of statistical distribution, which just went back to normal right after. Verified smart contract, as you can see, kind of consolidating in here. It's not a really clear sign now that we are in a massive adoption. So adoption will lag. Remember, the supply side of the equation will lag. But clearly here, what we see isn't something that's going better. It's actually the opposite way around. Back in 2021, things were improving, but of course the demand was improving faster. That's really what creates this kind of supply versus demand shift. But that's really like right now, we're consolidating. We're not just flat running. So this is really concerning to me to see that supply side bottlenecks in here, not bottlenecks, supply side things tend to give us kind of an opposite reaction. We see those kind of flat grow phases, and we definitely have gone out of a grow phase, which has fueled even more supply into this bear market. And now we might be starting to limit it, but really not really a fancy stuff to go by, is to say legitimate growth is going to come by both of these metrics going higher, not just demand going out of nowhere with supply being limited. Academic publication, as you can see, constantly growing over time. Job research interest, and here as well, consolidation, sign of the same old cycle. We see that there's been destruction in the previous cycle as well, so it might be still the same compounding effect as we don't retrace the same base afterwards. So we're building the base, waiting to see improvement, but same story in here. 2021 was growing with job research interest. We're not now. So multiple points suggest that when we switch to adoption indicator, the demand side, really, this is where we see adoption, okay? Active addresses have been constantly going up. So that's one thing that just assess for the brutality of the adoption. It's just unstoppable. And like we see, we expect now, I mean, this curve is the true replicate of this. We're really early now, okay? That means the next cycle is supposed to accelerate the rate of growth to a significant pace. Remember, this is where we are now, and we're going to add up double the amount of people that we have in the next cycle. This cycle is expected to last a bit longer as well than the previous one, so don't be among those who think that, yeah, it's going to have to be terminated about 2025 or whatever because the 4-year cycle. Yeah, no. It's clearly not that game again. Don't try to time the markets, okay? But this one clearly shows that the adoption rate is consistent and accelerating, which is very interesting. The transactions is where I'm very concerned because, frankly speaking, this is really the only metric that has been picked up demand recently. And we've seen that these new transactions are performed into either much more high throughput kind layer 2s or very high throughput blockchain like Solana, which nearly doesn't translate into fee paid, because we can see here that despite these things, we have not retraced to the previous kind of flat phase, but the thing is that we're still building the bottom, and we're far off eventually considering making new highs in terms of transactions fee paid globally. Remember, that's not just one Ethereum stuff, though definitely 2021 has been loading it up like crazy and DeFi summer whatsoever, but clearly what we can see here is that there is an uptick in terms of transaction, but it's certainly not translated in terms of actual money paid to the system. So kind of leading me to believe that this could be just faking out same stuff, people are just piling up like crazy on the same stupid narratives, creating fake transactions just in the process of looking for airdrops or whatever. I'm very concerned about that. I think there could be legitimate claims that the early stage bull market, which people claim we're in, could actually be just a full fake stuff. It could be just a false flag, false beginning of just the 2021 crowd once again playing the same old party saying, yeah, we can front run the opportunity. We know exactly what the next cycle is going to be made out of. Real world assets and stuff like that. We'll see that. There clear narratives is everyone talks about that, like gaming, real world assets, restakings. These are really the kind of stuff that people are piling in like crazy because they think this is an inevitable future and this is where they can still grow some market caps. But we'll see. Very dangerous stuff. because DEX volume is going higher as well, but not significantly enough to challenge the all-time highs anytime soon. Though the data points that we look at in here are just backing from November, so it could still very well change in the coming month, but this is something I will carefully gonna have to look at, because well, right now I see people calling like the bull market is inevitably in, and I doubt, frankly, that is the case. So many metrics from the adoption side in here shows that, yeah, we might have the beginning of something, but so many fundamental factors like stablecoin volume and all of this stuff just shows, well, these are the things that can easily be manipulated. And there is no signs of trends now in terms of DEX volume, which is one kind of fundamental factor for me. NFT buyers, even though there was an uptick, it's not significant compared to the data sets that preceding it. So that's really the way to go. Stablecoin volume as well. We're in this big range and we're kind of still in the middle of nowhere. So the data points that we have are very, very wide, not widely distributed. They're concentrated in just a few names that just accounts for all the upticks. The DEX volume has increased, but as you can see, overall, we're just in the mid part of the range. That's way too soon to consider any such a thing as the beginning of a new cycle. Transactions fee paid is really non-existent type of stuff. Though transactions only are the only ones making new highs, and that's really why I'm worried about. Chasing those narratives of created transaction, specifically created them in total contradictions to the fee paid, suggesting, well, those transactions are performed on either very cheap kind of transaction environments, which frankly is the case, and the truth is that who's actually performing those transactions? Because there are two answers to this thing. Either that's the new gang, that's the pragmatists who are going to be coming, and therefore that's the sign that the next cycle has already started and that the next wave of adoption is started by these increased level of transactions. Or this is blind fake fuck stuff. That's basically the same old crowd of the previous cycle, which is just playing the same old stupid game of I will time the market, I will front run the opportunity and dangerously getting ahead of wolves. That's not what I think it should be done, because frankly speaking, if we look at the data, it will still require so many months. I think another semester or quarter at least to see now both the fundamentals for supply improving as well as the demand starting to really picking up, because right now all I can see is that it's the same old previous kind of adoption trends that are still going on. I don't see the shift. I see evidence that we are getting through the chasm, which means we've lost some publication, we've lost some developers and stuff like that. We're really getting through somewhat of a different bear market. Active devs haven't just sustained flatly. We see now there is a question and a value pivot. We're really into that chasm period now, headed of pragmatists. And like we stated before, it's important to figure out the different psychology there is between these two crowds. All right, picking up to this, we would look at the early adopters. They're generally those who enjoy new innovation and comfortable with taking social risk, but are largely motivated by its potential to drive their success. They're very influential in the marketplace, acting as trendsetters. So that's really the way to go. Like we stated, VCs just piling up like crazy, anticipating the future and selling at a very high premium to an unadvised crowd of people just going in like they really want to be part of it. On the early majority side is totally different. It's made up of pragmatists who adopt new innovation only after it is proven and they feel comfortable that it won't put them at risk. So they're not risk taker, all right? They are the largest segment of the market, okay? It's very, very important for you to understand. These guys are risk averse. They will not take crazy shit type of amount of risks. So don't play 2021 over again. Don't go into buying the visionary stuff like playing the VCs over and over again. And what we see here in the data points is it might very well be the case now. Saying to me, all I see for now, until being proven wrong by truly unbiased data set, is for now I just see people creating fake out of nowhere transaction in the process of chasing airdrops or whichever front-running narratives they might be into just to get free tokens. And most of the time they're intending to dump them. So that's really, frankly, doesn't really show signs of next wave adoption. So the Bitcoin ETF has now been there. There are chances that we'll get an Ethereum ETF by the end of this year, certainly even faster than that. So that's clearly, to me, the sign that this is where the new innovation is going to come from, where the new onboarded people are going to go by. They're going to buy these well-renowned assets. They're not going to get into the shittiest fancy names, low-cap stuff below $100 million just for the sake of making a 100x return. They're not risk fucking takers. So there certainly is hell a lot of VCs out there, and they're still trying to do what the VCs are doing, which means they go in very early, do very solid due diligence research on the project, try to be as selective as possible, while also distributing the money out of 50 candidates so that they know that there is a significant luck factor in this business. They try to remove it to the least possible they can, but there still is a luck factor. That's the reason why they need to diversify their portfolio greatly, kind of spending 2% of the capital into 50 assets instead of just saying, yeah, this is the winner and betting it all into this one. That's the VCs. But the thing is that, well, then they need to get the money out. If they want to get those 20 or 50 X's, well, they still need to pump the price and find someone who's stupid enough to buy at that price. And I think that's exactly what we're in now. The VCs are just, flagging the same old 2021 game, seeing that, there might be traction in some narratives which they can sell to the public. These are the ones that we've seen, the kind of gaming, reward assets. So this is probably market fit in the future, but that's really the 2021 over again. They're selling you the future at a pretty dense premium now. Like Solana is going to process billions of transactions? Yeah, but where are the margins? Where's the money? Are you just buying into the growth factor, or are you really buying into sustainable revenue sharing and revenue distribution systems? I don't think Solana is anything close to being profitable. So that's really the way to go. Are the pragmatists going to look at the numbers and say, no, I'm not buying into this. It's not making any money and certainly not going to do anytime soon. So frankly speaking, I think there's a clear crossover into this next cycle. If I am correct, the next cycle is coming from pragmatists. These guys do due diligence. They look at the numbers. They don't fall down the VC rabbit holes of just selling fake data points or just spending out tremendous amount of money into commercials, advertisement, and just, trying to build communities and user bases. This is not what there is, okay? If you can take 1 million transactions out of a few individual users, great, but if you can't process any profitable margins out of this, it's just worth nothing, though that's really very dangerous to me. The narratives that have been at play so far are just that. People buying into this or that because it falls down this potential narrative that could drive the people's attention. That's 2021. That's really like, I'm front running the opportunity. I'm trying to get as early as I can because that's most of us have learned from 2021. If you want to take on those juicy 20, 50x returns, that's how to do it. But this time around, I think you're already late to the party. Truth is, most of the new coins that truly might be embedded value with them, they've been bought pre-seed by some of the highest, most prominent VCs out there. And the truth is, now these VCs are already at 100x returns. And you guys think you're front running the opportunity? I think you're exit liquidity. So I'm very cautious with these current narratives, like the real world assets and the like. There were significant gains to be made. But if your token has already made those 20, 50x, whatever, just get the fuck out of here. Just don't be the exit liquidity. Just don't wait for these tokens to go down. Most importantly, like I said, don't mix it all up together. The Bitcoins and Ethereum, they have nothing to prove anymore. They're really the kind of top asset class which is really, really demanded by these new guys, which means they will grow in value, not by printing money out of nowhere, out of narratives and fake valuations. These assets will just grow because the pragmatists will show up. Are the pragmatists going to pump it like $1 million Bitcoin? Frankly, not a chance. These guys are pragmatists, which means if they take too much profits in the line, they will sell. So these are not the kind of investors who will leverage up their trades and go to the moon, bro. Though don't get it that way. It's probably going to be a longer cycle, more investment driven, shorter volatility amplitudes, and all of these kinds around. So yes, this market has matured, and what it's going to cause it to change its structure. Forget about the 4-year cycle, forget about the same old VC investment schemes like, yeah, I can get in early. No, you can't. The true valuable asset have been bought long ago because all the VCs have been fighting like crazy to identify them. Okay, 2021, you somewhat had a chance because the amount of supply being created, these new projects, were just all over the place. So you still had chances to kind of front run the opportunity. This cycle around, yeah, we might see a hell of a lot of new stuff popping around, but frankly speaking, they're all crap. There are very few new assets which truly have value. And among those who do have value, yes, some of them will definitely airdrop significant valuations to their users. But once again, just focus on these. Do you really want to have a go chase any airdrop on stupid chains, whatever? No, you know they're probably not market fit. So just, I would say, stick to a few narratives, the very important ones. Like, I definitely think those that have been pulled out so far are somewhat interesting. I think there's going to be something playing around kind of games, but I don't think there's any chance for you to front run that opportunity. I frankly think the gaming narrative is just going to be one AAA game provider, like, I don't know, the big names, Electronic Arts, Blizzard, whatever, just one big kind of company jumping into the Web3. But do you really think they're going to just say, okay, hey folks, here's my testnet, come and play? No, it's just going to be where they're going to release a AAA kind of game, and people are going to play it just because, well, they have a good game. So that's really the way to go. I don't think there's one way to front run the gaming stuff. Yeah, you can surely front run any kind of low quality game, indie type stuff. But frankly speaking, I mean, if you look and study this market for just a second, you know that's 90% of the market share coming from gaming are made by AAA providers. So if you intend to make any money into the gaming narrative, either you buy shitty altcoins with absolutely close to zero market cap and the eventual hope to make 100x. Good luck with that. You might find one, but probabilities are very narrow. When on the other hand, well, those very likely going to attract the pragmatists' money, yeah, they're going to come out and they already have their business model. They're probably already existing AAA game creators. So that's for gaming, in my humble opinion. The second one is real-world assets. And frankly speaking, I think there will be asset issuers out there that's going to come out of nowhere, but they're going to be private asset issuers. So most of the time, this is going to be private companies issuing their own assets on chains with their own security collaterals or stuff like that. And this is not, once again, the type of money you can front run. These guys will create their own kind of onboarding process to real-world asset digitalization. So, frankly speaking, you don't even have a chance to take money on this. There's clearly the kind of Chainlink as a public source blockchain for these Oracle perspective stuff to tokenize assets for big blockchains like Ethereum and others. And I frankly think this is nothing like a stupid narrative, but this is not the kind of narrative that's will 200x or 20x. If you take a Chainlink's current market cap, if it 20x's, it's going to be freakingly expensive. So that's really the way to go. Once again, I think those narratives, some might be true, but they won't play out the way people see them. Just because it's not 2021 being replicated over again, we're in a different market environment. The cycle might be very much longer than the previous one. Could be shorter. I mean, don't try to play the time game, okay? We're still headed into some of the same areas. I don't really forecast how fast we'll get there, but I doubt we're gonna have to take it for granted the fact that we have to be there in let's say 1 or 1.5 years. It can take much longer than that. It doesn't really matter to me how fast we get there. I just think that the assets who will be able to go all-time highs, there are not that many of them. I think the Ethereums and Bitcoin of this world, frankly speaking, that's an almost guaranteed stuff because, well, most of the forthcoming adoption of pragmatists, they will adopt these technologies. They have proven to be market fit. They have proven to be resilient and all these things. So yeah, Bitcoin and Ethereum, of course they'll be there. Is Chainlink probably going to be as well? I think it will. I think that's the #1 top real-world asset issuer for public blockchains. But remember, most of real-world assets tokenization is going to come from private sectors, and these guys will bring their own value on chains. You won't stand a chance to take any margin out of this. So that's really the way to go. The other narratives, Well, yeah, despite gaming and real-world assets, we've seen somewhat a fancy stuff about restaking and kind of shared security modeling. And like I said, well, you can pile up like fucking crazy into the eigenlayers of this world and say, yeah, they're the new frontier. Well, they're not the new frontier, right? May I remind you that the Cosmos ecosystem has had shared security for more than a year now, and that's probably where the actual opportunity lies. So frankly speaking, like I said, go for the narratives, just don't go for the crowded trades. I think most of the time the crowded trades are worth it. I'm not saying don't go farm the eigenlayer stuff. All I'm saying is eigenlayer is anything but a risky investment. Certainly there are coming risks with this. I mean, smart contract risk could definitely wipe out the entire ecosystem if there ever is a bug into the eigenlayer smart contracts. But despite that, well, the problem to me is that the airdrop will likely come. The airdrop will likely be coming along with a significant amount of money airdrop to the community. The problem is there's so many people going in for this that the amount received by each individual is probably going to be heavily diluted. Most importantly, I think Eigenlayer isn't going to airdrop everything to this point-based system. If they do it smart, they're going to widely airdrop their tokens. Certainly not the way it was done last year or 2021 style with the arbitrums and the like. It's really not how it goes. Back then, it was really tremendous amount of market value distributed to a significant low portion of actual users. Now this time around, everyone is piling like crazy into those names. So yeah, the Zk Sinks, the eigenlayers, and all of these kind of Ethereum top-notch projects, they will airdrop, and you very likely would like to farm them. But the question is, do you really think you're going to get 50K out of this time around? I frankly don't think it's going to happen. So try to be rational with that, okay? Just spend some time doing it. And frankly, I'm not saying don't follow the airdrop narrative. All I'm saying is don't follow the shittiest airdrop narratives. Don't go for the few dollars a box sent out here and there. Most of the time, you're giving away information for this, either because you're linking your social medias to your on-chain address, which is frankly very dangerous. Remember that if you want to remain somewhat pseudonymous, you certainly don't want to give any connection to you in the real world by linking some assets here and there, okay? So you don't want to do this. The second thing is, well, for what purpose? Spending an hour and a half to just get a $10 airdrop in the end. What the fuck is that? I mean, if that's the amount of work that pays off your time, well, I don't, frankly speaking, all those lower cap airdrop stuff like that, I don't even pay attention. If you give me those tokens out of nowhere by just holding out them or whatever, I'm going to sell it. Surely, I will. If you ask me to do stuff for a $10 airdrop, yeah, fuck it. I'm not going to do it. And I think many, many people should ask themselves around that. Focus on the airdrops that would eventually get to bring something valuable. Don't try to play it with 10, 20 accounts. You're going to easily be detected as a Sybil. So don't do it, okay? The second thing is, well, try to be smart when you do it. They will probably be much smarter than the previous cycle to figure out how to target their users, okay? So just don't play the stupid games of going in here and swapping here and there once a month. No, try to get consistent each and every week. Get there, repeat the operation. Don't just play the same swap in and out just to create fake transaction values. That's not how it goes. Try to be smart with your airdrop tracing. And by being smart, I'm saying be targeted. Don't go all over the place trying to chase all of the airdrops. That's stupid. Don't try to go with the real-world asset narratives. I mean, frankly speaking, most of the added value by this narrative is going to be privately sicked. The second thing is, well, like I said, gaming, probably going to be some massive private player in here jumping in with both feet on the real-world asset, on the actual gaming stuff. And guess what? Do you really think they're going to create and they're going to play with Solana blockchain or whatever shit like that? These guys have millions in treasuries. They can just fork Solana and create their own blockchain with their own tokens out of this. So frankly speaking, once again, remember that the private sector will retain one thing above all, that's governance power. They will probably airdrop some tokens to get their community to have some words to say in the process, but god damn it, they will never deploy in a third-party blockchain. Don't be stupid enough to think that. So those who are farming airdrops in Solana for gaming stuff, whatever, what you're going to be farming for is the indie stupid games that don't worth anything more than the indie game worth today, which means absolutely nothing compared to the AAA players. So Don't chase the real world asset. There are probably lots of tiny value airdrops to be taken out of this, but it's going to take much more time and effort coming from you to find the ones that could worth it. That, frankly speaking, net, I think you're better off just having a day job. So, I mean, if that's for 10-hour research to get a $100 airdrop, fuck it, man, you're making more money with a normal job. So don't go down this path. Try to make a good use of your time, or just take it for some nice research. Once again, if you have some time to spend, which you don't know what to do with, well, just get yourself a better person. Learn stuff on the internet. Just don't go playing some stupid game repetitively just for the sake of making $100 in the end, which is just an hypothetical amount. And most importantly, you're going to sell that shit immediately afterwards. It's not like building value. It's just wasting your time and everyone else's in the process. So don't do this, all right? Please don't do this. And last but not least, well, like we stated, be very cautious with restaking. I don't think Eigenlayer is that kind of fancy airdrop everyone is going to be very, very happy with. Could be a good airdrop, certainly, but don't put the money you're not willing to lose into this, okay? It's very dangerous that way. It's not going to be as easy as it is. And most importantly, the restaking narrative, I think, is going to play a hell of a lot more into the Cosmos ecosystem, which is by far the first mover advantage in this world. All right. That being said, I'm going to leave you guys with that to avoid having that video to go way too long. So TLDR is that the adoption metric that we see now suggests that we are getting through the chasm. This is really a painful situation in which there is a clear question of value and a pivot in the long-term adoption. We're definitely going to get out of the early stage adoption, which is the early market. We're getting into mainstream market for the heavyweights. The Bitcoin, the Ethereum, the chain links, the atoms in Cosmos ecosystem in general, they've been created in 2014 for most of them. Some have gone to the market very early, some took years to be built and then built out the market, but they are long-term projects. These are the ones that have green light for mainstream adoption, not the others. That doesn't mean there's some new stuff isn't going to come out from the tech enthusiast innovators phase or visionaries. There is constantly overlapping cycles, but the truth is most of the newly coming money, okay, because the general crypto adoption is there, is going to go into this big heavyweights name for the reasons that we've explained. They adopt only after it has been proven and being comfortable that it won't put them at risk. They're not risk takers. So if you're playing the VC game, hoping that someone dumber than you will buy at a higher premium than you bought it for, good luck with that. The early majority is less likely going to jump into the rabbit hole. So that's the warning sign for today, okay? And if you do follow those narratives, airdrops, chasing, hunting, stuff like that, gaming, real-world asset, do it smart and be very cautious with that. They are very dangerous narratives in my humble opinion. And most importantly, if you're jumping in now, like you've missed the whole game, okay? This cycle has started last year. We're in very late now. So if you're getting into those narratives at the moment, or if you know anything or anyone around you just willing to jump into those narratives, just really show them that video. That's crucial for them to understand that it's not the time to jump into the narrative now. You're pretty fucking late to the party. The message in here is pretty much for those who are already in, hoping that there's more to come. I very well doubt it, frankly. So if you've made some nice gains, book them before the prices retrace. When I'm saying this, I'm not saying just get the hell out and sell it all. I'm not saying just take at least 50% profit. That's the bare minimum to me. It's not just, yeah, okay, I'm 20x in. I'm just taking a few % profit to refund for my initial investment. And the rest is in the process of going to the moon. Well, I don't think that is. You have a nice gain, really take half of it at least at that point. The significant probability of these things to be full of shit, which means there's no one really bringing value to this project. They're short-sighted, short-term games in an overcrowded space, where on top of it, true long-term value has been and is being improved upon every day now. And this is where the money will go this time around, not chasing stupid narratives, which you think you're smart enough to be front-running now. Okay? That being said, trade safe, be smart, try to target the long run. There's so much value created by these assets. And remember what we stated earlier, there's two ways you can make money in the market, by either being smarter than the rest of the market or by figuring out where the value is headed. Because value can definitely create some money. And if you are participating into figuring out what that value is, and if you're patient enough to give it some time, remember the value takes years to pull in through the market. So if you have years ahead and you're willing to invest, though, buy the coins, buy the assets. Just don't buy the derivatives with over-leveraged fancy stuff just to get richer than you could. That's really the way to go. Don't try to time these things. Value will take its way into the market. It will take its time. If you try to time the market appropriately, you're very less likely going to make it. All right? Probabilities are staggeringly against yourself. We know that most traders are losing money. That's a fact. So either you want to think you're smarter than the rest, just to probably be proven wrong like everyone else, or you just figure out that by patiently identifying the value and give it some time to push into the markets, you can just make as much money. And it's just actually more productive. So buy the tokens, buy the real ones, not buying the shit. Be patient. Don't try to get rich quick. And see you on the other side. Bye, guys.